Are you ready?
I'm always ready.
Are you ready?
Oh, yeah. Get ready. Get set. Hit it.
I saw you were with them last night. I saw you were with them last night. Don't burn the bridge, burn the paper.
Yeah, that's engaging time coming to a venue near you this summer. Keep your calendars open for engaging time. That was Don't Burn the Bridge, Burn the Paper. This is 101.5 FM WLCB, Slade's Corner, Wisconsin. You are listening to Your Insurance Corner. My name is Bill Miksch. That is Sean Hauser coming to you live from the bunkers in Columbus or Dayton, Ohio. And well protected. Welcome back, Sean.
You'll get it one of these times. Yeah. I'm well protected like a strong contract from an A-rated carrier.
There you go. Absolutely.
That was pretty good.
Yeah, it was a good one. We'll have to book that, and I'll have Ryan put that in the archives in our tape and make sure we flag that one for another time. So folks, we're talking about the different kinds of annuities. We just covered what a fixed annuity is, what a multi-year guarantee annuity is, or a MIGA. One last thing about MIGAs that I don't think I said, MIGAs generally don't have any fees either. And to some degree, they all have some waiver for nursing homes. Some, I shouldn't say all, some have waivers that if you end up in a nursing home, depending on the contract, you can access the principal without surrender charges. But MIGAs are generally not built for those kinds of things. We're going to get into this thing called a fixed indexed annuity now, where there's a lot more moving parts, but these are programs that are either growth oriented or they are income oriented, meaning that yes, they will guarantee you an income for the rest of your life. As an example, last year we did a program for clients that I think they were 67 years old. They were both retiring, and based on the amount of money they dropped into the annuity, they were going to get $40,000 a year for the rest of their lives. And when we looked at that income stream, plus some other investments that they had, plus their Social Security, Sean, I know I've told the story before, but you saw the stress come completely out of their body when I told them, I said, you're going to make about the same amount of money that you were making before your retirement. And they were blown away by that. You could just see no more stress. Their house was already paid for. They had other investments, so they had liquidity. And they were never more than happier that they had a chance to meet me, and I was able to put them in that position. A fixed indexed annuity can be growth. Let me explain what a fixed indexed annuity is first before I get into some of the moving parts. So if you're doing a growth annuity, these things have access to what are called the indexes, like the S&P 500, the Russell 2000, a variety of other indexes, some of which you've heard of before and some of which, frankly, you have not, but they're all trackable on the web. These all have URLs that you can drop into or links that you could drop into in the market, and you could see real time what those indexes are doing. However, when you're in one of these indexes, let's just use the S&P 500 because that's a very common, easy to understand index. When you're investing in the S&P 500, you're in it completely, which means, and this is not an annuity, you are invested as an investor, whether it's qualified IRA money, but you're in the index. You're taking advantage of the upside, the dividends that are being generated by the 500 companies in the S&P 500. You're fully invested in it. If the market goes up, you participate in the uptick. But if the market goes down, you're going with it, just like a roller coaster ride. And we just experienced this, have we not, Sean, in the last couple of weeks, where in some cases we've seen a 10% or greater loss in the indexes.
Oh yeah, we had 3 or 4 straight weeks of losses, and Friday barely pulled out a winner.
Yep.
Boy.
Yep. And I don't. That's my opinion. I don't think we're out of the woods yet by a long shot. But so that's the S&P 500 is in. You're in the index. I'm sorry. You're invested in the S&P 500. In the index, you're not invested in it. Let me say that again. In an annuity, you're not invested in the S&P 500. You're mirror imaging what the index is doing. So let's just use simple numbers. Let's say the S&P 500 is worth $100, and today you're investing in an annuity, and you're going to put all your money in the S&P 500. No problem. Knock yourself out. Next year, when your contract renewals has an anniversary date, we're going to take a picture of what the S&P looks like a year from now versus what it is today. If the market went up, you'll participate in some or all of the growth, and then your floor will reset. If it goes down, short of maybe having a fee in your policy, and I'll get into why you'd have a fee, short of that, your floor does not get impacted. So if you put $100,000 in there and there's no fee and the market takes a dump, you still have $100,000 next year. If you were invested fully in the S&P 500, I guarantee you don't have $100,000. So that's the first thing. Your money is protected. We call this keeping some of your money safe, or safe money. So you can position your money either for growth, and then you want to look at the indexes and see whether or not there are these things called caps or spreads. A cap is something that says, we'll let you have up to 5% of the growth of the S&P 500. Anything over that, we get. Or a spread might say, we're going to take the first 5, anything over 5% you get. These are common in annuities, and you have to pay attention to those. Now, some people might say, well, I don't have any of those problems if I'm fully invested. Correct. But the insurance company is guaranteeing that you're not going to lose money. So they can't give you the entire access to the cash register. They have to protect their bottom line so they don't go belly up and your money goes with it. So that's why those caps or spreads are included. Now, there's one other item in these indexes. It's called a participation ratio. And what this means is that they might say, we're going to let you participate 50% in the S&P 500. Which means whatever the S&P did, you get 50% of it. In other cases, Sean, I've seen where the participation ratio can be upwards of 250%. Buyer beware. Let's take a look at that index and see why they're letting you have 250% of the index. Is it a brand new index? Has it been around for a long time? Or is it underperforming and they're trying to entice you to put more money in there so that they can get those better returns? It's really important to take a look at that to make sure you know what you're looking into. But you're not in any of the indexes. You're simply mirror imaging them. At the anniversary of the contract, it will reset. It'll reset at the floor where you started, or it'll go up and then the floor is reset altogether. Whether you do a growth-oriented or a income-oriented, these indexes basically work the same way. Now we talked about growth, and again, the same rules of surrender charges apply. You might do this for 5 years. I don't see commonly a 3-year fixed index annuity. Maybe they're out there, I've just not seen them. 5 years for sure, 7 years, 10 years for sure. and you're keeping your money safe and asking for a reasonable rate of return. But income is a different thing, and that's a goal for the client. So if the client says, I want to park this money in there, and in 10 years I'm going to turn on the income. Okay. Well, now you've got two different buckets of money that you are going to look at. One is your money. It's called the accumulation account. That's your money. The indexes have a direct impact on that side of the account. Let's call it the left side. The right side is called the protected income value, or PIV, protected income value. Other companies use different words, but protected income value is very common use for the income side. And oftentimes you're either going to see a bonus on that protected income value and or something called an interest rate roll-up. And I know people's eyes are going to start to water here, so let me just make it simple. A roll-up is nothing more than the insurance company saying, Sean, we're going to give you 7% guaranteed compounded for the first 10 years on that income side. It's not your money, but once it gets to the 10 years, whatever it says there, compounded, that's what we're going to base the income off of. And then depending on your age or your spouse's age, whoever the youngest person is, the income will be drafted based on the younger person. That PIV, when you're doing a 7% compounded thing, Sean, we talked about the rule of 72. Your money is almost doubling, right, in 10 years?
Yeah, that's correct.
So, and then it's a matter of the carrier saying how much at a certain age they're willing to cut the check for you. And so it's based on your age, it's based on the strength of the company, et cetera, et cetera. That income, folks, is guaranteed for life. For life. Your accumulation account or your money could run to zero, and that income is still going to happen, no matter what. Now, I've mentioned a couple times there are fees that are built into some of these products. The fee is generally there so that it can guarantee you an income for life, and in some cases, it's also including a provision, a long-term care rider, where if you become sick or disabled and you're going to need long-term care, whether it's nursing home or home health care, they will allow you to access the principal. Let's say you haven't turned on the income yet. They will allow you to access the principal after a 2, 3, or 5 year period, again, depending on the company. No questions asked. And in some cases, you have to be in a nursing home for 90 days. In other cases, you just have to have a doctor certify that you can't do 2 of the 6 active daily living activities. Can't get out of a bed without help or a chair. Can't dress yourself. Can't feed yourself. Can't bathe yourself. Can't go to the bathroom by yourself, or your incontinence. Any 2 of those 6, or you have the organic thing of Parkinson's, Alzheimer's, or dementia. If you are in a nursing home for 90 days, that will trigger the access to the principal, and the surrender charges oftentimes will be waived. On the other hand, if you've turned on the income, what I just said is now off the table. However, there is a concept called the doubler. So let's just say, for discussion purposes, you're getting $50,000 a year for the rest of your life for you and your spouse. And one of you ends up needing some level of long-term care, and a doctor certifies. The income will now double from $50,000 to $100,000 until your accumulation account or your money runs to zero. Now, some people might say, well, Bill, the account's at zero. What happens to my income? It goes back to what it started out as, $50,000, because the promise was no matter what, you're going to get this income for life. But while you still have money in your accumulation account, In some contracts, they will double the income until your account runs to zero.
And then you go back to the original amount, correct?
Exactly correct. Exactly correct. Now, if the account runs to zero, and the next question is, what do my beneficiaries get? They don't get anything because you ran the account to zero. No different than any other kind of an account. If it runs to zero, there's nothing left. On the other hand, if there's still money left in the accumulation account, when both you and the spouse pass, whatever is there does not go back to the insurance company. Let me say that again. It does not go back to the insurance company. It will be distributed to the beneficiaries, whoever is on the list at the time you pass away. There's only one circumstance, Sean, where the money will be returned to the insurance company. Do you know what that circumstance might be?
Only thing I could think of is fraud, but it's probably not that easy.
It's not fraud. It's called a life annuity. It's called a life annuity, which I don't think anybody uses anymore because that's old school. What a life annuity was, or a life with period certain was, I'll just use life annuity because it's the easiest one to explain. You were going to take an income at the highest level the insurance company will allow for the payout. And let's just say you were going to get $100,000 a year for the rest of your life. And 6 months into your retirement, you got to, let's just use round numbers just for illustration purposes. You had $1 million in there. You were going to get $100,000 a year because that was the promise. 6 months after you retire, you pass away. You bought a life annuity. The insurance company won. They get the other $900,000. That is a terrible thing to have happen to somebody. There's only one circumstance where I could see that would be a rational decision. You've got no beneficiaries, and you've got a big estate. Because if once the income stops, that annuity is no longer in your account. It goes back to the insurance company. But I don't know of anybody that shows a life annuity any longer because of that particular provision. Most people will have beneficiaries, or if they don't, they have charities they may want to give the money to. So there are other ways in which to take the income without giving it back to the insurance company. My opinion, life annuities and what are called life period certain, which is like guaranteed for 10 years or life, whichever is whichever comes first. So if you have a life with 10-year period certain and you die in the 11th year, the money's gone. If there's still money in the account, it's gone. So in an income account, if the indexes lose money, just like the MIGA or just like the other indexes, you can't lose anything unless there's a fee. And we've already just talked about what the fee might entail. We talked about the long-term care provision. Let's talk about variable annuities as we're coming up to the top of the hour. Variable annuities are very simple and are complex at the same time. The first thing I would say, Sean, is variable annuities are meant for the savvy investor, somebody who understands risk, knows that what goes up can come down, and they will. Variable annuities are in the market. Unlike an indexed annuity where you're mirror imaging the index, you are in the index or whatever the mutual funds are inside the variable annuity. I'm not going to poo-poo them. We don't sell them because we're not licensed to. But here's the rub with variable annuities. Most variable annuities fees are 4.75%. And that's mortality and expenses and insurance costs and the mutual funds getting their piece of the action and the insurance company getting their piece of the action. And so 4.75% on average comes off the top of your portfolio before any money gets invested. And I would tell you that the some of the agents that sell that kind of stuff only tell them one piece of that fee. They don't tell them the whole thing. So all I would say is a variable annuity should be only sold to a savvy investor, one that understands risk, and doesn't have a problem with a 4.5% fee baked into the account. The one upside of a variable annuity is that it can take money indefinitely, whereas the MIGAs can't, the fixed accounts can't typically, and in some cases the fixed indexed annuities can't after the first year or two. They just won't let you deposit any money. So variable annuities are more flexible, and in some cases their surrender charges are not as long. Surrender charges have to be disclosed because the client needs to know, if I need the money tomorrow, what's my penalty? So they need to be disclosed. If you said that Sean, if you told me that you might need the money in 4 years, an annuity is not for you, especially if we're buying one with a 7-year surrender charge, because I now know that you're needing the money in a shorter period of time. We either look at a different product or we choose a different financial vehicle. So you got to pay attention to that. The one thing about fixed and MIGA, and I was going to talk about that. We're still good with time, 5 minutes. A fixed and a MIGA account, Sean, are period certain. Let's say you're buying a MIGA for 5 years or a fixed account for 5 years. The insurance company is going to send you a letter about 30 days before the anniversary of that contract. You've got 30 days to make a decision as to what you want to do. Otherwise, the insurance company is automatically going to roll it over into another 5-year annuity because that's what you did 5 years earlier. And so the advisor needs, and you, the buyer, have to pay attention to that so that you don't get caught with your pants down. And all of a sudden you thought, you've got $150,000 come available to me. It's non-qualified money. I'm going to roll it into, whatever. Or if it's an IRA, I'm going to roll it into an IRA rollover at my bank so I can start picking at it. And the MIGA goes, oh, not so fast, Sean. It rolled over to another 5-year and you're kind of stuck. So when you're buying a MIGA or a fixed account, a big deal is to know when that thing renews so that you can stay on top of it. Annuities by their nature, folks, are tax deferred, every single one of them, whether it's IRA money, Roth money, or non-qualified, which means just investment money. All the money that's growing in there is zero taxes on you until you withdraw the money. IRAs are fully taxable. Roth IRAs are not taxable. And non-qualified money is what's called first in, last out, which means interest first and then principal. So that's important to know. When you're pulling money out of a non-qualified IRA, you're going to pay some income taxes on that money. And again, IRA is going to be fully taxed. Buying these things gives you some guarantees and peace of mind, gives you a reasonable rate of return, can guarantee an income for life. You cannot run out of income. And if you are charitable driven and your estate's big enough, you can put things into a charitable remainder trust. Let's say you want to drop $2 million into a charitable remainder annuity trust, and then you're going to get income for the rest of your life out of that. When you pass away, the what's left in the annuity is now going to pass to the charity of your choice, and the government gets zilch on their estate tax. So it's a very useful tool for gifting in that regard. Sean, any questions?
No. I think I've heard this somewhere before recently.
Yep. I think the biggest fear right now, Sean, is people are afraid of running out of money. Advisors.
Well, if you think about it,
go ahead.
You always see those television, those television news exposés about the guy that thought he had a comfortable living and now he's working, at the grocery store or something just for to make ends meet because he can't afford his medicine or he can't afford, to be retired, or he had to take a loan to help out a child, things like that. So it's frightening because when you get to 65, 67, 70, 62, you're thinking it's time to relax, and you just never know. Will I have enough, and will it last me until I go on?
Right.
So.
Yeah, exactly right. So as a part of your planning portfolio, consider one. Not everybody's qualified though, and I'll just leave you with this: if you've only got $100,000 or $200,000, I'm not sure an annuity is right for you, because liquidity is a big deal, and if you run into healthcare problems and you've buried $100,000 into an annuity and you've got another 50 or 75 floating around as liquid asset, I've walked away from some cases, Sean, that because of that very issue. So I think the right buyer is anywhere from 250 and up. That way you've got liquid assets, you've got liquidity in your portfolio, and you've got some guarantees coming in, your Social Security, your pension plan maybe, and then this. And the rest of it is however you want to manage your affairs. So I hope this was helpful. This is a big deal for a lot of people. Lots of people are retiring. What did I tell you? 12 to 14,000 people are turning 65 every day. So this is a big deal. Folks, we're at the end of our show. Sean, you have a great day. I'll be talking to you soon. Tell Kelly I said hi. You guys enjoy the week. And actually, we'll see you on Saturday. Either by Zoom or by in person. We'll see. That's Sean Hauser. My name is Bill Miksch. This is 101.5 FM WLCB. We'll see you next week, folks. Have a great week.